Welcome to the Finance Podcast. The topic of this episode, climate indexing, with Robert Edwards from Morningstar, Switzerland.
And thank you for joining me. I want to start by apologizing for my lack of any language skills outside of English. Actually, barely English, but I understand there is a gin tasting, so maybe if you have enough gin or wine, maybe it starts sounding like German at some point. I don't know. If someone wants to test that later, 3, 4, 5, it's probably somewhere in that range. So my name is Rob Edwards. I work out of Morningstar's London office. I'm Director of Product Management for our ESG index business. My day-to-day job is basically working with our research teams, figuring out kind of what new ESG indexes the market wants us to build. I decided to talk about climate indexing today because I think it's relevant. I think I've been in Switzerland a lot this year, and I think there is some agreement and disagreement, I think, amongst investors in terms of the relevance on ESG investing. But I think the way that I always kind of come back on that is whether you're a believer in climate investing or sustainability or whatever it is. I think this market is big enough now that it's relevant. It's material enough that you need to know about it, essentially. So I'll cover a few different topics in my short time today. So in terms of the agenda, I want to go over, talking about in the climate space. And I think when I think about climate, I think it's something that is actually over and above now ESG. I think climate and the environment is kind of overtaking the broad ESG market in terms of what really matters in the market, and especially to investors on a global standpoint. So I'm going to start by reviewing the climate fund landscape. This is research done by Morningstar's manager research team in terms of where the flows are growing, what types of products are selling kind of broadly in the global market. Then I'm going to talk about Morningstar's indexes, and I'll talk a little bit about our business in a minute here. And also a new index that we just launched 3 weeks ago. So this was actually inspired by kind of what happened in 2022, where I think a lot of investors that had switched over to, I would say, like a low carbon type portfolio or climate transition portfolio, they had a little bit of a shock when oil prices reversed. So we'll kind of talk about what we did there, kind of post what happened in that kind of oil reversal from 2022. And then talk about performance. We wrote a white paper a couple months ago around the ESG performance, especially looking at 2023, because I think it was a really interesting year if you compare the different types of ESG strategies and how they actually performed during 2023. I think on face value, you usually think technology does well, all ESG markets are going to perform well. So then talk about kind of what's next in the market. So a quick obligatory plug of our business. So I think a lot of people are familiar with Morningstar in general, 12,000 person company, lots of different things happening with Morningstar, different business units. But we've actually had an index business for the last 20 years or so. So I like to think we're somewhat of a well-kept secret. And when I talk about our business, really what I kind of refer to our index business is somewhat of a microcosm of everything that Morningstar has to offer. So Morningstar, we own Sustainalytics, which is one of the biggest ESG data providers. We own PitchBook, which is probably the biggest private markets company. We also have our own equity research team, kind of sell-side research team, so we leverage them very heavily, as well as a quant research team. So what that's really allowed us to do is really expand what we do in the indexing market, in equities, fixed income, multi-asset, and private markets. So we leverage all the capabilities we have across, again, this kind of broad Morningstar ecosystem to create a wide variety of different indexes. About 2 years ago, we also got into what I would call an index white labeling business, which we call index services. We bought a company in London called Moorgate Benchmarks. Basically, the idea there is if you have your own kind of index idea that you want to calculate an index, you can send that to Morningstar. Morningstar can kind of do all the ugly kind of operational and back-end work for you. So if you want your own kind of large cap growth index, Morningstar can calculate that on your behalf, and you own the intellectual property. In terms of our business, I would say our two main client segments are one on the what we call investable product side, so ETF issuers, asset owners. So we work with the BlackRocks, JP Morgans, government pension fund of Japan's, those type of clients. And then On kind of the active side, you see we have over 500 billion US dollars tracking or using our benchmarks from an active fund or a wealth manager actually benchmarking their portfolios against our indexes. So jumping into a bit of the climate fund landscape, I think this is pretty interesting research, and we just updated it. I think we just released it last week, actually, the updated numbers through the end of 2023. So what we first started to do is looking at the whole market, and this is going to be encompassing basically what we can have publicly available information on. So mutual funds, ETFs, SMAs, things like that, maybe not private markets and things like that. But what we're trying to do is break down the climate kind of strategies into different kind of segments. So just a brief kind of overview of what the type of funds are. On the left-hand side, we have basically low-carbon funds. You can think about those as funds that keep kind of the investment thesis of a strategy, but maybe they have 20% or 30% lower carbon intensity compared to a benchmark. I would say these are the type of strategies that have probably been around, I guess, the longest. And I'll talk a lot about these towards the middle, the climate transition type products. These are, if you're familiar with things like Paris line benchmarks or climate transition benchmarks, these are portfolios that have a very defined decarbonization trajectory or are picking out companies that are farther along in terms of the climate transition. And then on the other side, you have kind of more solutions-oriented products. So these are going to be, I would classify more as kind of thematic solutions. So green bonds, obviously, where you have your proceeds going to something specific. You also have climate solutions. You can think about that as like a circular economy type product. And then clean energy or technology, so renewable energy, anything kind of in that realm. So what I thought was interesting is I obviously knew Europe was way ahead in this space, but when we actually saw the numbers, it was kind of stark in terms of how this market is almost entirely being driven by Europe right now. I'll talk a little bit more about the headwinds in the U.S. in a bit, but I think this really kind of shows where the entire market is at geographically and how much of a leader that Europe is. So you can see, this market, and again, just talking about mutual funds and ETFs essentially has surpassed the 500 billion mark pretty much just towards the end of the last year. And I think we've done a little bit of research, and that number has continued to grow into 2024 as the market's rallied a bit. I think it's also interesting to look at, what types of funds are kind of gaining popularity and what's kind of trending. So you can see the climate transition funds are probably definitely the biggest in terms of overall assets. And you saw 2021 was obviously a very critical year. I think you can kind of thank the rollout of things like SFDR, where a lot of funds maybe were just a market cap weighted strategy and they converted themselves to maybe a low carbon or a Paris line benchmark. I think we saw that quite a bit in the market. So you've seen a lot of these assets go specifically towards these more transition or decarbonization, net zero, whatever you want to call them, type products in the market the last 3 years. I think it's also interesting to look at this kind of regionally in terms of what's popular in each market, and you can kind of see some of some of the overall national things happening there. So China, you can see very intensive in investing in greening their grid and renewable energy and things like that. So you can see that's really shown up in the type of investments they're having as well. So really not interested in terms of these transition type products, solely focused in more of these solutions-oriented products, where you see a fairly diversified mix in terms of Europe. In the U.S., you could see it's fairly diversified, but in the end of the day, it's not very many assets overall. I think this is probably the most impactful slide in terms of this kind of portion, which is the flows that happened the last few years. So again, I think you saw a lot of inflows in 2021. Again, it's on the back of however many years of tech rally. So I think there was a lot of emphasis in terms of switching over to those products in 2021. I think especially factoring in interest rates, I think they've been much more kind of damaging to the types of portfolios in the climate solutions or clean energy and technology. You actually saw those kind of products were globally in a little bit of an outflow in 2023. But the one area that, again, has been really consistent in terms of inflows has been this climate transition area. So I think it's going to be a very interesting year in terms of these flows. So I'm really excited to, when we update this through June at least, to see, I think there's obviously a lot of market dynamics happening to see whether this kind of trend towards these transition products continue and whether there's any bounce back for these climate solutions. Because as you can see, 2021, tons of inflows, interest rates start rising. I think performance has suffered and it's probably pushed some investors away from new flows into that market. So I showed the same graphic earlier, but I like to show it again because we actually like to put our own indexes into these buckets because I think there's been a lot written about index providers and how many hundreds and thousands of indexes are out there in the market. So I think it's always helpful to have some sort of categorization into that market. So we use this kind of same thing, and I like to introduce the concept of tracking error just so people kind of understand where most of these indexes and portfolios will fit in terms of an investor's portfolio. So again, the low carbon ones, you'll have more lower tracking error, again, with the climate transition as well, something more broad-based. I think it's, again, can be a core holding in an investor's portfolio. And just to go through kind of a couple examples just to kind of bring that to light. On the low carbon space, I'll use our first one, which is our minimum volatility, which we call reduced carbon at the end of it. And basically, it's very similar to any other kind of minimum volatility strategy that you would see there from an index standpoint. But what we do is have a target, basically a 30% lower carbon intensity at the portfolio level. Yeah.
Sorry, just a question.
Yeah, please.
The term transition, I mean, this just refers to like adapting to higher temperatures?
Yeah, I think it's, I think it's a really good question. I think we use this as more of a broad term, right? So I think anything that has a decarbonization trajectory in it, so I think the fund names you'll see or index names you'll see there are going to be, net zero or transition, Paris aligned. Yeah, whereas I think if you're, investing in like EV and AV companies, it's going to be more of a solution. So I think you can think about it more as kind of, is it a holistic portfolio or is it something that's actually like a solutions-oriented product? So yeah, I think the best example, and they've been, if you measure it by assets, I would say wildly successful, at least from an EU perspective, is the climate transition and Paris-aligned benchmarks. So those were, if you're not familiar, kind of born out of broader regulation. That's kind of the first time I think globally that there's ever been a really defined index methodology in terms of minimum standards and criteria. And I think the last time that we looked, there was something over 150 billion USD, utilizing that kind of Paris-aligned or climate transition label. So I would say based on that accord, it's been very, very successful, given that it was just rolled out 2 or 3 years ago now. And so you'll see, I think, some proliferations on that. I think the EU is very excited about that success, and I think you'll see, more and more kind of benchmark standards around kind of ESG benchmarks specifically. On more of the thematic solutions, again, this is kind of a wide variety. I'll use our climate action indexes as an example. These are basically tied to a company's revenues, looking at what companies are aligned to different SDGs and aligning those SDGs to ones that benefit the overall climate. So next I'll talk about this new index series that we just introduced, again, 2 or 3 weeks ago. And if anyone's interested, we wrote a white paper and there's a lot of kind of content that we've published, especially with Earth Day and things like that this week. So we call it the Morningstar Low Carbon Transition Leaders Index. And I mentioned kind of our inspiration to doing this was, I think we heard from a lot of investors in 2022 that were invested in, especially things like Paris-aligned benchmarks, where they had almost no exposure to the energy sector. And I think it was a bit of a shock. And I think that's, part of why we like going out and talking about these different indexes is to kind of inform investors about, what they're actually investing in when they're investing in a benchmark. Because let's be honest, I think sometimes it can be an opaque market. So what we're trying to do with this index is really capture companies across sectors, so not just low carbon companies already, right? We don't want to just capture technology companies or communication services companies who already really have a low carbon footprint. They still matter to the transition. I think we think all companies matter to hitting any sort of net zero goals, right? But there's some industries that we actually need to support. I think is kind of our philosophy behind these indexes. So how are we actually doing that, right? I think we created basically a new scoring system with 2 key metrics to be able to pick companies in the index. So the 2 metrics are carbon intensity. So we're using scope 1, 2, and 3, scaled by enterprise value, including cash, which is similar to the Paris-aligned benchmark. So you'll say isn't that what everyone uses? I think, yes, that's very commonly used in a lot of carbon benchmarks, but it's only kind of half the story, right? So I think that gives us where companies are today, where have they been, it's somewhat of a lagging signal, right? So that's 50% of it. Where are they at right now compared to their peers? And I think the really kind of differentiated part is using what we call the low carbon transition rating from Sustainalytics. I mentioned Sustainalytics is a part of Morningstar. And this is a new rating. It's a very detailed rating that looks at 85 different metrics in terms of what companies are actually doing in terms of what's in their control in terms of the climate transition. So it's not just looking at, if you're familiar with SBTI targets or something like that, not just saying, hey, we're aligned to 1.5 degrees. They're actually going, what's the performance towards these targets? Are they actually making progress towards them? There's other things I like in there, like remuneration policy. So is a company's CEO's pay tied to hitting these targets that are set? So it's very forward-looking, I would say, versus kind of the backwards-looking element of carbon intensity. So it gives you kind of this backwards, forward-looking element in terms of what are they doing right now, and what actions are they taking to kind of set themselves in good position, going forward. I would say the other things that we're trying to do with this index is actually upweight companies in the index based on criteria that we hear a lot about. So, one thing that's very clear in the market is, when we built this index, only 25% of companies were reporting their scope 1, 2, and 3 emissions. So we actually give a kind of an emphasis or a boost in the weight compared to a market cap weighted index to the companies that are actually reporting their scope 1, 2, and 3 emissions, because you can't really know where the global economy is from a carbon perspective until people actually start reporting this and reporting it accurately. So we're trying to really not just use the stick approach, but actually use the carrot approach in terms of reporting their emissions data. And in terms of, from a portfolio perspective, this is meant to be a kind of core holding replacement. So it's what I would call a best-in-class index. So again, we want to look at all sectors. So we're picking the top 50% of companies by those 2 scores by market cap. So again, something that's very benchmark-like in terms of kind of the macroeconomic sector perspective, but picking the companies that are farther ahead on those 2 metrics is really kind of our key goal with this new index series. So I talk about some of our objectives already, using and identifying these kind of climate transition leaders, I'll call them. The other kind of factor that we use is green revenue. I think what we hear from investors a lot is, it makes sense in these type of portfolios to be holding the companies that are farther along already, and those are the ones that are usually already in a green industry, so renewable energy, green buildings, green transportation, things like that. So we're upweighting those companies. One thing I think it would be different than a lot of these other portfolios is we're not targeting a specific reduction in carbon intensity, because we feel at times that can be kind of a random guessing game in terms of what are you actually targeting. So we actually have lower carbon footprint at the portfolio, but we're not targeting one. So when we ran kind of the back test and simulation of these indices, depending on the region, we saw we had about 20 to 40% lower carbon intensity on a portfolio level. And I mentioned we're not reducing tracking. We don't have a tracking our budget, maybe of like 50 basis points or something, but we're trying to reduce tracking our overall by basically, again, keeping kind of that sector exposure similar to a market cap weighted index. So as an index provider, we're very rules-based, so we like to kind of show this in terms of a stepwise manner. So we start with our large and mid-cap Morningstar indexes, and we have 9 different variants of these, so global, European, US, et cetera, in terms of the different variants. And then we do, like many of our other indexes, I would say ESG-based exclusions, but they will actually, in terms of these exclusions, look quite different than a lot of other, I would say, climate or environmental focused benchmarks, where our goal is to not, again, exclude the entire energy sector. The only energy exclusion we're doing is thermal coal extraction. I think most people agree that that's an industry that's hard to actually make kind of transition friendly, versus other spaces of the market. But we also do, things like controversial weapons, UN Global Compact compliance. And then in terms of, picking the stocks, essentially what we're doing is we're combining those 2 metrics and then picking the best top by market cap. So kind of going down the list by the ranking of these 2 metrics until we hit 50% of market cap, and that's what we're doing to keep the sector exposure similar to a market cap weighted index. So just looking, quickly at performance, because of course that does matter. So our top index is this new benchmark, the low carbon transition leaders. In the middle is our Paris-aligned benchmark, and the bottom is the market cap weighted index. I think, again, what's probably most interesting to point out is I like to show the 2022 performance. Of course, it's not good for any of these portfolios, right? Based on what happened in the market. But you can see, it's somewhat in the middle between a Paris-aligned benchmark, which really struggled based on kind of its tilts towards technology and communication services, where the low carbon transition leaders was again, didn't have that kind of removal of the whole kind of sector from an energy perspective. I'd like to kind of showcase this through some of the constituency indexes as well. So these are the top 10 holdings of our developed markets ex-North America index. I don't like to show developed markets because it's boring, because it's just a bunch of US companies. So we can look at the parent weight of the market cap weighted index versus our what we call LCTL for short index in terms of the developed ex-North America index. So you'll see essentially 4 of the top 10 holdings do actually make it into the index. So Novo, ASML, LVMH, and AstraZeneca are in the final portfolio, whereas the other 6 don't make it into the final portfolio, because again, it's based on those 2 relative scoring systems, carbon intensity, and this new management score that we use. And so we like it that way too, because we're just looking at 2 metrics. It's not really crazy sophisticated ESG thing where there's lots of different levers being pulled. You can go to a company that's not in the index or isn't in the index and say, these are the 2 areas that you need to improve if you want to make it in the index. So hopefully it's simplifying that story overall from a selection perspective. So kind of last thing I wanted to mention is talking again about ESG index performance and climate index performance a bit too, because I think it was a really interesting year from an ESG perspective in terms of performance. So I've already said, I like to always say, like, these things are not the same when you compare them. So make sure that you know what is underneath the hood from a selection perspective. What are your active risks towards a benchmark? Because what we saw in 2023, when we have lots of ESG indexes, so there's, I think, a good volume of indexes that we can study. 44% of them from 2023 outperformed their non-ESG equivalent, which is up from 2022, which was a dismal year at 2027, but down from 57%. The numbers do look better if you look at a 5-year figure. So from a 5 years, it's 61%, so it improves. But you can see the 5-year number went quite a bit down, whereas if you look at 5 years at the ending of 2022, is at 78%. So again, it was a rough year, and you have to understand kind of why and the dynamics of these different indexes, because if you just look at it, the overweights from a sector perspective, you would expect pretty much all of these indexes to outperform. You see the performance of the global technology index from Morningstar, it's 52% versus a little over 6% for the global energy index. So if you just look at the sector perspective, so these are dismal colors, I'm sorry about that, but if you look at technology, purple is the large and mid-cap index, red is our Paris-aligned benchmark, and yellow is our global sustainability, which we use pretty much a consolidated ESG risk score from Sustainalytics on. So looks at not just environmental, but also social and governance issues from I would say, a financial risk perspective. You would say, they should outperform, right? But then if you look at, some of the actual company level data, what's really apparent, at least on Sustainalytics scoring system, is companies like Amazon and Meta and Alphabet actually do really poorly from an ESG risk perspective. I think Meta is 98th out of 99 in their industry from an ESG risk rating perspective. So those companies aren't getting selected. So obviously they had banner years of performance. Same thing with Amazon. I think it's 3rd from last in their industry. And I think Alphabet and Meta both were not even qualified for the index because they had severe ESG controversies around data privacy and security. So again, it's kind of preaching the story of looking underneath the hood and understanding kind of these very differentiated ESG indexes in ESG portfolios, because again, the Paris sign held up very well in 2023 because it was overweighting these companies that holding NVIDIA, overweighting Apple and things like that, whereas you missed out on a lot of the top performers if you were just looking at more of a broad ESG rating. So the moral of the story here is understanding kind of what your scoring metrics are and what's happening in the portfolio underneath. This is just a quick snapshot of the table from the white paper that we wrote on the performance. You see a lot of red from, these are, again, the broad indexes that use the ESG risk rating as a selection criteria, whereas you look at our Paris-aligned and climate transition benchmarks, in obviously a much stronger year from a performance standpoint, just because of, again, the overweighting from companies that are low carbon intensity. So just to wrap up here, kind of what's trending from my opinion and what's next. I think from an ESG perspective, broadly, I think there's going to be continued headwinds in the U.S. I think until at least the elections. I talk to a lot of clients all over the globe, but from an ESG perspective, and I can say, it's going to be a very continued, tough market. I showed the graph at the very beginning in terms of the geographical, footprint of climate funds, and I expect that difference to even just continue to grow. While I think the U.S. kind of sorts itself out, you may have seen that they even pushed back on some kind of, I would say, low-level climate regulation from an SEC perspective. So I don't think anything is changing there until, again, November, when there's a big U.S. election happening. I also mentioned there's, I think at least from a government perspective, I think the EU, saw their Paris-aligned benchmarks as very successful. So if you haven't seen what they're developing now in the market is something where they have kind of a lower hurdle rate to start with, so they don't have such a high kind of decarbonization at the beginning, but what they'll call it is a taxonomy benchmark. So this is going to be kind of the second version of a regulation that's going to set the minimum standards for a new benchmark, which they're using kind of taxonomy data, so companies that have revenue tied to the EU taxonomy alignment basically built into that index. So that's going to be coming down the pike as well. And then again, every survey that we send out, especially, we do an annual survey with asset owners and other kind of providers, climate is still king. Again, climate, is the number one topic from an ESG perspective. And you'll see more kind of focus on things like biodiversity, and again, moving away from things like just using emissions to more, physical risks, transition risks. I think moving away from more kind of hypothetical, theoretical products, and again, moving to more things that are easier to manage and measure, and things that are a bit more tangible to investors. So that's it for me. Thank you for hanging with me at the very end of the day here. So I'm not sure exactly how much time that we have, but happy to take questions now or after.
I have a question. Thank you. Very interesting. I was wondering, among all these indexes, do you have common blocks of variables and factors, and then you just add, or because evolution they are quite similar, and suggest at a certain point you have common factors which behave the same way?
Yeah, I think I would say the only commonality that we have really is we're trying to start with a very similar baseline of exclusions. So I think, the things that we can't agree on, I think, are like controversial weapons, UN Global Compact. I mean, I think as an index provider, we're obviously, we're working with primarily clients in Europe, but, we work with, places like Japan and the US, and I think they're going to have very different kind of opinions in terms of like what those metrics are. So we try to have a baseline, but I think it's evolving so quickly. It's very difficult to have a standard. And it comes down to what you're trying to achieve. We have these ESG risk ratings, which are very much focused on the financial risk side of ESG, and then you have climate, which is very much focused on that. So I think it's going to be hard to standardize. I think there's just too many different kind of opinions and wants from the market until, maybe things come together. But I think we're still quite a ways away from that. Thank you. Yeah, so when it comes to biodiversity, I think if I had to put a guess on it, probably about 2 years. I think, last year there was the task force for nature-related financial disclosures that came out and was finalized. I think it'll be a while until you can actually properly manage it. I think it's a very complicated topic. I think nature is probably going to be maybe the most, I don't want to say controversial, but complex topic to measure when you think about all the different things involved in nature in terms of natural habitat risk, maybe having to use like geospatial data to understand where companies' like footprints are from a nature perspective. So I think we're a ways away from things that are comprehensive. We've actually stayed away from making any biodiversity products in the market because we've seen what's out there, and I think it's very risky and limited in terms of what's been put out in the market, and not very succinct with actually what needs to happen. Okay. Well, thank you very much. I'll hopefully see you down at the gin and wine tasting downstairs.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.